One of the largest shocks to the market over the last year or so has been inflation. We've seen pretty hot inflation. The Fed said it was going to be transitory. They have reversed that. It has caught some market participants offside. It has caught others not so much offside. We certainly expected it to happen, and we don't have any sort of date on when it will end or top out or how long it can continue to go. I don't have any sort of forecast on that. What I do have predictions around is the upcoming CPI report. And I've today pieced together a few things that I hope can provide us an edge, and hopefully we're correct. We're not always correct, but we try to be quite often. So, step one, what is the market anticipating? I watch CNBC pretty much all day. I'm on Twitter pretty much all day, just kind of being a sponge. And Stephanie Link is a CNBC contributor who is a professional money manager and someone I respect very much, and who I assume is very in tune with broader Wall Street. And broader Wall Street has a lot of money under management, and they're making decisions based on their forecasts. And they have something called a whisper number. A whisper number is the number that is being floated around by banks and top analysts to their most favored clients, kind of letting everyone know and letting everyone in on what their highest grade of investment research is. And the whisper number, according to Stephanie Link, for inflation is right around 5%. That's lower than the 7% read that we got last time. However, if that truly is the whisper number, I think it's going to end up being incorrect. And of course, I can be the one wrong here, but I have two pieces of big data that I think are super crucial to this. One is the rise in energy prices. We saw that 7% CPI last quarter with an average barrel 20% lower than it currently is and has been since the start of 2021. We're getting January data coming up, and we've had very expensive data in January. In addition, the Pentagon just said they have to delay doing their 2023 budget forecast for inflation. Now, okay, sounds fair, but when you really think about it, what has the Fed focused so much on the past 2 years? They focused so much on their language and their messaging and their communication. I view this, possibly, this Pentagon delaying the budget thing, as a quite material event for the stock market. My assumption is the U.S. Department of Defense, if they need to get a piece of information, they can get a piece of information. So if they're making a public comment on their budget and inflation, my assumption is the inflation reading we're getting on Thursday is going to be quite hot. So we'll see what happens with that. I think this is something indicating possible hot inflation. Now, let's say we do get hot inflation. What happens there with the market? Well, it seems logical based on the mechanics of the market engine that yields will rise on more inflation. So yields rise. We know what that means for tech stocks, unfortunately. All things we have to be aware of. But we're not acting, at least I'm not acting, in a mechanistic way. That means I'm not going all in on shorts on tech. As a matter of fact, if we get a hotter than expected inflation read, then we get rising bond yields and tech sells. I've got about 20% cash position. I'm getting ready to deploy to buy up some of the 10x techs we talk about, and we're actually doing quite well today. And I'm ready to step in and buy those. Why am I ready to walk into the fire as rates may be rising, as inflation may be occurring, and that meaning that tech stocks should decline? Here's why. So inflation is 5 to 7 to 8 in the single digits, we'll call it. Bond yields 1, 2, 3%. These numbers, all in the single digits. The stocks I'm talking about buying after Thursday, if we get that hot inflation reading, are growing at 50, 60, etc., quite large numbers percent annualized over a 10-year time horizon. So do I think those slightly rising rates of inflation and bond yields may have an effect? Certainly. I led with that. I'm sharing that perspective with you. But at the same time, I'm also looking at these stocks that have these tremendous growth rates and looking at their price. And not just the fact that their price is off 50, 60, 70, 80, 90% from its 52-week high. The percent decline is important, but not the most important thing. The price that I'm looking at is their market cap. The market cap, the price you're paying for the asset you're getting, is quite important. And a lot of these stocks I'm looking at, I'm saying, okay, this is a risky company, for sure. It's doing a risky technology. But if I study that technology enough, and I have a good grasp on it, and my business acumen is decent enough, can I project a business model that with this transformational technology, will yield significant cash flows multiple times the current market cap? And for many of the stocks that I'm looking at in this 10x growth category, the answer to that is yes. I'm not going to go into all of them, but I'm going to highlight one because I think it's very understandable and relatable to any investor. And I'm just going to start this by saying it has a competitor, Invisalign. So you really have to get into the weeds here before you make a decision, but it's certainly possible to consider a bunch of factors and make a decision. The stock I'm talking about is Smile Direct Club. Now, Smile Direct Club, what's its technology? The ability to replace braces. Plastic, clear braces that you can wear for 6 months or so, depending on the type of situation you're in. The time tends to be faster than braces. It looks better than braces. It's cheaper than braces. It's also cheaper than Invisalign. The market cap is relatively small and very small compared to where it was. The company is actually making money, quarters of $200 million per quarter on the low end before, after COVID. COVID has certainly taken a hit because we've seen it in the makeup industry, etc., travel, etc. And I think there might be a solid rebound, and the stock is at virtually all-time lows. So that case I view as quite compelling. The market cap is very low. The amount spent on braces is quite high, much higher than the current market cap. You factor in the variables, the unknowables, the competition risk, etc., and you make a decision on what to do with the stock. That is how I'm looking at a stock like Smile Direct Club and how I'm looking at other 10x growth stocks. A lot of them I view as compelling. Energy I viewed as compelling with a different framework. And I'm not saying the energy train is too late to hop on. I don't want to call it train. At this point with energy, you have to do a similar and possibly even deeper analysis on its long-term energy propositions. Because assuming oil is here forever at these prices, these companies are tremendously cheap. I mean, Exxon will make its market cap and value in like less than 10 years at annualized last quarter's earnings. This quarter is likely going to be higher. Who knows about Q2 and Q3 this year? So annualized last year, we're at a less than 10 PE. You got a massive dividend. It's quite a good investment. But the reason why I like Exxon is because I don't need to worry as much about is oil going to have the same demand in 10 years from now. They've got so many loaves of bread in the pipeline that I'm quite compelled to take part in the renewable future. Similar analysis not 100% the same, a little more cash flow right now focused. So that's today's video. And until next time, peace out.